Welcome to the Allan Small Financial Show. Thank you once again for spending a bit of your busy time in the day with us today to talk about what's going on in the world of finance, investment, making sense out of what's happening out there. I always say we encourage as many of you as possible to feel free to ask us any questions. You can send us a message through YouTube, Facebook, whichever way you're watching this broadcast today. And let us know what you're thinking. Let us know what your questions are. I'd love to be able to help you answer them. This is a show that we plan on having every few weeks. So the next show will be July the 27th on a Wednesday again at 12 noon. We want to keep it consistent so all of you can mark your calendars so that you can get ready for the next show. And again, this is mainly to help individual investors really navigate through these turbulent waters, especially these turbulent waters that we've been feeling over the last 6 months of this year. To start, again, one of the worst years we've seen, it dating back all the way to 1970. It's been the worst 6 months for the markets since 1970, so 50 years. And I think individual investors have a lot of questions to ask, and we're going to try and help you answer those questions today. So today we're going to talk about a few things. We're going to talk about the Federal Reserve and Bank of Canada. They're obviously undergoing a interest rate change, a higher interest rate policy. We just heard from the Bank of Canada this morning, and they raised interest rates a full percentage point. For some of you that have not seen the news as yet, looks like the interest on your loans, on your variable rate mortgages and lines of credit will be higher by 1 full percentage point. Prime rate is going up. We're also going to talk about this week, what I call this week, which is the part of the show where we focus on what individual investors need to focus on or understand over the next 5 to 10 business days before they make their individual investment decisions. And we're also going to touch on building a portfolio. There are a lot of bargains out there. And as I talk to my investors, my clients, we talk about improving your portfolio, perhaps going from some B quality names to some more A quality names, because those A names right now are a lot cheaper than they were. Lastly, we're going to talk about fee structure, different types of fee structures per account, a flat fee, commission-based account. What are the differences and what type of fee structure should you have? And then finally, we're going to answer your questions. So if you have any questions regarding the markets, regarding anything in your portfolio in particular, send us a message. I'd love to help you answer those questions. And we'll do that at the end of the show, but feel free to ask those questions throughout the show. So as I mentioned, the Federal Reserve and Bank of Canada, they've definitely started to raise interest rates over the past few months. Now they say started to raise. I'm going to say they've been raising for a little bit now. I know the Bank of Canada mentioned today in their press conference that they want to front load these higher rates, raise rates now so they don't have to raise rates later on, later on in the year. I'm not so sure that would be front loading. I think we're probably closer to the end of the higher interest rate rising cycle than we are towards the beginning, but maybe not. Maybe the Bank of Canada has in mind that they'll raise rates a few more times. And the Federal Reserve seems to be taking a similar path. Their press conference and their meeting won't happen until later this month. And the Fed has already said that they will raise rates, or the indication is they'll raise rates 75 basis points. Today, the Bank of Canada was supposed to raise 75 basis points, but they raised a full percentage point. So what does this mean for the average Canadian walking the street? What does it mean for investors? What does it mean for someone who's looking to purchase some real estate, buy a new home, or buy a big ticket item, in which case they may have to borrow some money to do it? Well, pretty simply, to borrow money today is going to cost you 1 percentage point higher, or as much as 1 percentage point higher than it did prior to the announcement. The banks will usually take a little bit to get on side with the hike in interest rates. So you'll probably start to hear that our major banks will raise their prime rates by the end of today, or maybe by tomorrow morning. What does it mean for individual investors? Well, as you can imagine, whenever interest rates are going higher, That's not a good thing for the stock market because overall it is not a good thing for the overall economy. Businesses are constantly borrowing money to grow their business. Businesses are constantly borrowing money to improve their business, to hire more workers, to basically get ahead. And when you raise the cost of borrowing, this makes things a lot more difficult for these individual businesses. And so the stock market, as we know, which is a reflection of the overall economy, a reflection of these individual businesses that trade, these publicly traded companies. So when businesses are having more of a difficult time, their costs are rising, which is what we're hearing from many CEOs at this time, both in Canada and in the US, stock market is going to reflect that. If corporations are struggling right now, the stock market will struggle. And because we don't know when the inflation rate will start to drop, which is why the Bank of Canada and why the Federal Reserve is raising rates at this time, because we don't know when inflation will start to fall, there's this uncertainty in the marketplace. There's this uncertainty in the stock market. And as we all know, nobody likes uncertainty. So overall, we've seen very volatile markets, and we will probably continue to see this volatility happen until such time where we start to get a hint that perhaps these central banks will start to slow down their interest rate hikes. I was hopeful that we were going to see some positive numbers this morning, both in the United States on their inflation data, which came in at 9.1%, one of the highest rates in over 40 years. And I was hoping we would see a 50 to 75 basis point hike in the Bank of Canada, but we didn't see that. So we're going to have to look towards, I guess, the next month, July numbers, to see if this stubborn inflation were to come down. And we'll have to see how the Bank of Canada and the Fed will react to that when we get the data in the future. So this is the part of the show where I talk about what I believe individual investors need to focus their attention, where they need to focus their attention before they make their investment decisions over the next 1 to 2 weeks, 5 to 10 business days. The first thing I'm going to say, and you probably would guess, is we need to keep an eye on the inflation rate. We just received the most latest June data out of the United States showing an increase in inflation all the way above 9%, the highest we've seen since the early 80s. That is definitely not going to make or get the Federal Reserve to slow down their interest rate hiking policy. In Canada, we tend to be a little bit further behind. We tend to tell our Bank of Canada tends to get the inflationary data a few months behind the United States. So we're still looking at inflationary data from the last few months. So as that starts to come in, and depending on what those numbers are, that's going to dictate what the central banks are doing with regards to interest rates. So I think we need to keep one eye on inflation. A second thing that individual investors need to focus on going forward is other economic data. Data like the 10-year government bond rate. As interest rates move higher, the 10-year government bond rate moves higher with it. So right now, we're 10-year bond rates in the United States are trading in and around 3%, now slightly higher. In Canada, our bond rates are a little bit higher than that. We're probably in that 310, 315 range. But overall, as interest rates rise, as central banks increase their rates that they're charging banks, prime rate or overall interest rates will rise with it. And that includes the 10-year government bond rate, the 5-year government bond rate. And so one of the things you may hear on TV and some of the experts speak about is sort of the yield curve. What's going on with the yield curve? Normally, when we look at interest rates, the 10-year rate is probably higher than the 5-year rate, the 5-year higher than the 2-year rate, et cetera, et cetera. If you go out and buy a GIC, you expect that if you're locking in your money for 5 years, you should earn a higher interest rate than if you did it for just 1 year. Right now, what's going on is the 1-year rate, or in this case, the 2-year rates, are actually higher than the 10-year rate. So we say the yield curve is inverted or upside down. It's not working like it's supposed to. And that, unfortunately, tends to signal more often than not that a recession could be coming in the next 6 to 12 months. So keep an eye on the 10-year government bond rates. Let's see if they're getting back to normal where the longer rates are paying higher interest than the shorter ones, or is it still inverted? And let's keep an eye on how high these rates can go. A third thing that I believe you should keep an eye on over the next 1 to 2 weeks is the price of oil. We've seen the price of oil fall significantly over the last, let's call it week or so. It was trading well above $100 a barrel, and now we're into that $95 a barrel range. Unfortunately, I think the price of oil has fallen for the wrong reason. I think it's fallen because we're seeing some of the demand or some of the growth coming out of really places like China, United States, and other places around the world start to slow down. And when we see or believe that there's going to be a slowdown, China perhaps maybe going back into a lockdown in some areas due to COVID. They have a zero COVID policy, and we're starting to see COVID start to show some higher numbers with respect to people having COVID in China. So they're starting to shut certain cities down in China, and that's not good for demand, being the second largest economy in the world. So overall, we're seeing the price of oil fall because perhaps the demand is falling. But I think that will be just temporary, and eventually China will reopen again and the demand will spike a lot higher and oil prices will probably move higher again. What we want to see is oil fall because we have more supply. We need more supply of oil. We need more supply from the United States. We need more supply from the OPEC nations to make up for the lost barrels of oil that we are no longer using from Russia due to the invasion of Ukraine. So those are the three things I think we need to focus on. We need to focus on the 10-year government bond rate. We need to focus on oil prices. And sorry, the third thing is GDP. I almost forgot that one, probably the most important one. GDP is the third thing I think you need to focus on. We're going to get a GDP reading or a growth reading out of the United States. That's going to happen in the next few weeks. Is the United States in a recession? If we see a negative number, a GDP number, or negative growth number out of the US, that will be the second negative number in a row, second quarter in a row of negative growth, and that will signal a recession in the United States. So we need to keep an eye on where GDP or growth is out of the US and in Canada as well. Canada has just taken down our growth numbers down to, in the 3% range for this year and as low as 1.5% next year. So everyone's taking down their numbers. They're taking their numbers down for their growth expectations. So we need to keep an eye on these GDP numbers going forward as well. So I talk about a lot of different things. I talk about interest rates, 10-year bond rates, GIC rates. I talk about growth in the economy. I talk about oil prices. What does this all mean for your portfolio? And I think that's what everybody wants to know. And that's why you're watching, pretty much in my opinion, why you're watching this broadcast. What does it mean for my portfolio? Well, as many of you know, right now, portfolios are struggling. People are not sure where to invest. What should I be investing in? Should I just keep my money in cash? Should I be buying something that's quite conservative, maybe a utility or a telecom company, just earn a very small dividend, or maybe buy something that pays a bit of a bigger dividend? Or should I be buying something for growth? So what I've been doing with my investors, my clients' portfolios over the last, I would say, bunch of months now, is instead of trying to time markets, get it out of the market, get back in the market when I think times are better, or sell off and panic, which is what you never want to do, I've been kind of going down this path of trying to upgrade quality of portfolios. We want to upgrade the quality of portfolios. And what I mean by that is all portfolios for the last bunch of years, we've had some A-class names that are leaders in their industry. And we've also had some more B-class names because those leaders in their industry were just too expensive. They were too expensive to own or to buy. Well, guess what? Now those A-class names are actually a lot cheaper, and names that I think you could actually move some of the B-class names into. Take some money out of those, I guess, secondary names and put it into those more important or primary names. The names that you're building the core part of your portfolio around. And if I was given a bunch of money today and asked, okay, Allan, build me a portfolio, where would I start? Well, First and foremost, I would start with the banks. You want to look at names such as Scotiabank, CIBC Bank. These are two banks, in my opinion, that not only have gone down in value by quite a bit, down as much as 20% over the last year, but these are also names that pay fantastic dividends. And even though they've gone down, they give you a great entry point to buy these names, right? You're buying these stocks on sale for 20%. And as we know, living in this country, if you ever look at a bank chart, I know we have up a chart here that shows the last year and how much it's fallen. But if you take a longer term chart or a longer term approach, which we don't have, but that's okay, you'll notice that most of the bank stocks, the chart starts in the bottom left and moves to the top right. In CIBC, Scotiabank, I choose those two names because they're yielding the highest amounts right now. I could have chosen TD or Royal. They're also yielding over 4%. So starting with our Canadian banks, I tend to use banks as a place to put money when times are tough, volatile, and anytime these banks sell off to a certain degree, that's the first place I look. But you also can look at US banks. JP Morgan comes to mind, the largest US bank, the largest bank in North America. JP Morgan, too, has sold off over a third of its value. So it's actually sold off even more than the Canadian banks. Another name, maybe not as good a dividend, paying just over 3%, but a name that if I was looking to upgrade a portfolio or create a new portfolio from scratch, a name like JP Morgan, Morgan Stanley's another one that's fallen quite a bit. Another name, a little more into the wealth management and the trading side of things, whereas JP Morgan is more of a traditional bank. So another name that I think you should consider or take a look at if you can handle the volatility in some of these names. Some of the other names and some of the other sectors, such as technology, perhaps you want to look at a Microsoft, a Google, or an Amazon. Three companies that, again, as you'll see in the charts, have fallen so much. We haven't seen falls like this in some of these names in many years. Names like Microsoft, which I think is one of the best companies in the world. How do you not buy these names when they're 25, 30, or even more more off their original or their 52-week high price? Owning a name like Amazon, I think is fantastic. How many of us get an Amazon package every day to our homes? And you think, how can this company not be doing well? How can the stock price fall this much? And then lastly, to cap off a great portfolio, maybe add a couple of chip makers, some of the biggest chip makers in the world, and AMD and NVIDIA. Again, chip makers tend to be a little bit more volatile. So you have to be able to withstand the volatility in these names. Make sure that you can do that. And then maybe you end off with a pipeline or an oil company, an Enbridge, a Kinder Morgan pipeline out of the US, or maybe you add an oil company, Suncor, CNQ, Canadian Natural Resources, or a Chevron. And there you have a nice diversified portfolio, not only of names that have fallen tremendously and give you the opportunity to buy low to eventually sell high down the road, but you also create a portfolio that will pay you a fantastic dividend for most of these names, something that, a dividend that you can collect and earn while you wait for the growth to come down the road. So investment opportunities, there are a lot right now. There are a lot of things on sale. And I know it's you got to have an iron stomach right now to start putting more money to work. But these are the times that set us up for future growth down the road. Times like we saw in March 2020 with COVID, or financial crisis in 2008. Those that invested during those difficult times, remained invested, or added more money to their portfolios were rewarded in the years shortly after. Fee structures. That's a question I get a lot. As an investment advisor, one of the first questions when I meet with someone at the initial meeting is, what are your fees? How do they work? What do you charge? How do you make money from someone being my client? And so for today's purposes, I want to break down fee structure really into two things, or into two different structures. One is pay as you go, or commission based. When you have a stock, or let's say a stock or a mutual fund, and you're looking to make a purchase of that investment, there's a commission that is charged, whether it's 1%, 1.25%, whatever that investment advisor is charging you, that would be the charge for that transaction. So it's commission based, or as I like to say, transactional based. So if you make a trade, you pay a commission. If you don't make a trade, there is no commission that you have to pay. With mutual funds, a little bit different. Stocks you pay when you buy a stock and when you sell. But on a mutual fund, for those that own mutual fund portfolios, which I know there are many of you, you pay a commission when you buy the mutual fund. But when you sell the mutual fund, if it's front loaded, which most mutual funds are sold on a front loaded basis, and we can get into that maybe at another show. When you sell the mutual fund, it actually there is no cost. It's actually free to sell. So you only pay a one-time commission when you buy the mutual fund. And that's what I do in my business, a one-time commission when you buy the mutual fund. I guess I can't speak for other investment advisors. They may have another way of structuring their fees, but I guess that's what I do, a one-time fee to buy a mutual fund. And when you sell, there is no cost. Then the second way, or to set up a portfolio, or another fee structure more commonly used today than really ever before, and it's the way that most of the bank investment firms go, is that flat fee. And what that is you pay a set percentage for that investment advisor, in this case myself, for example, to manage your money. So it's a management cost, or a fee for service, as CRA would say. And if you're not looking at a registered plan, so if you have a non-registered plan, so a non-RSP plan or a non-TFSA, so nothing registered, so just a regular investment account, Canadian, US, whatever you have, Canadian or US dollars, that fee is actually tax deductible, because government will look at it as saying a fee for service is tax deductible. Now, of course, I would consult your accountant to make sure that you're able to tax deduct that fee, but in most cases you should be able to. And so obviously consult your tax expert before you do it. There could be some instances where you cannot deduct that fee, but as I've said, most of the time fee for service is tax deductible. And simply put, that fee is charged. It's charged 1/12 per month, so you get a little bit taken out of your account every month, so that way you don't get hit with this large annual fee at the end of the year. So it gets divided amongst 12 equal payments, and that fee comes right out of the account, whether it's an RSP account or a tax-free savings account or just a simple Canadian investment account. A little bit comes out every month and goes as fee paid. And so a lot of clients say to me, oh, you mean I don't have to write a check or send you anything? And the answer is no. That investment account or RSP account is really its own entity. There'll always be cash there to take the money out if the portfolio is managed correctly. And if not, if we have to make a sell every once in a while, we'll have to factor that into the management of the account. So overall, these accounts are kind of, are on their own, if you will, managed by the advisor, myself, and the fees come out on a regular basis. The last thing I'll say about the flat fee is usually you see flat fees, that approach done on larger accounts that are above a certain level, let's say 200,000-300,000. If you have a 50,000 or 25,000, or let's say under $100,000 account, you're probably going to want to go more transactional, not as many transactions. And so you probably want to pay per transaction. But once you start getting north of 200,000-300,000, there'll be a lot of transactions done on a regular basis, money coming in, dividends being reinvested, money going out, etc. And that's when having a flat fee can really be a benefit, because you're not being charged for these trades. You can do as many trades as you like. That flat fee encompasses all costs, a one-time 1%, 1.5%, whatever the advisor is charging, depending on the size of the portfolio, usually dictates the percentage that'll be charged, and everything is built into that 1%. So all encompassing one-time annual fee, and that's another way that individual investors like to go. And I think it's also good because as the portfolio moves higher, the investment advisor obviously gets a percentage of a higher amount. So the interests of the portfolio moving higher are also in the advisor's best interest. So you both benefit as the portfolio moves higher. And so you kind of get away from this whole idea, well, my advisor is just churning over my account, doing transactions just to earn a commission. When it's a flat fee, you don't earn when you make a trade. As the portfolio goes higher, the advisor, yes, will make a little bit more money. And unfortunately, as the portfolio will go lower, if it does, the advisor makes less money. So there truly is incentive for the investment advisor to keep an eye on things, and really try to get this portfolio going in the right direction. So a lot of people like the flat fee route, and is definitely something that more and more investors are working towards or setting up in their portfolios. So that was the best part of the show, where I talk about or answer your questions, talk about what you want to hear, any questions that you may have. And we'll try and get as many questions as we can done. And if I don't get to them today, perhaps send me a message. You can always go to my website, send me a quick email, and I'll try and, I guess, address those questions or answer your questions after the show. Looking at some viewer questions, looks like any thoughts on, I'm seeing a question here, adding some money towards Dollarama. And I guess the question is on still adding Dollarama to a portfolio, because Dollarama is trading near all-time highs. And I think that's a great question. Dollarama, I think, is in the area, I would say, of a type of business that will do well if an economy slows down. I think it'll do even better when an economy slows down, because they have products, obviously, that are cost effective, or they don't cost a lot. You're looking at, items that are only a few dollars. I know we say Dollarama or dollar stores, but most of the items in the store now are more than $1. But it's working. I think Canadians or Americans, they're going to these dollar stores. So I think, yes, I think you can always add a name like Dollarama. I'd be, I guess, looking at the price per share at this point, because I think Dollarama right now might be a little on the pricey side. You might want to, if you want to take a position in a name like Dollarama, maybe you dollar cost average in, maybe take an initial position, wait and see if it were to pull back a little bit with the rise in interest rates. It may or may not. It hasn't seemed to pull back as yet. So I think this is a name that a Canadian investor can own in a Canadian portfolio going forward, because I think this name, even though a little on the pricey side, I think it can maintain their upward momentum. But I think, as I said, I think a good strategy would be to dollar cost average into it. I guess a second question here. Let's see here. Will today's interest rate hikes cause a recession? Were you surprised that they were raised by a full point? And how will this affect my stock portfolio? Well, we kind of answered a bit of those questions already. I guess, will it cause a recession? Well, in my opinion, I believe that the United States is already in a recession. They just haven't, their data hasn't been released yet to tell us that they've had 2 negative quarters of GDP. So I think the US is already in a recession. I think here in Canada, we've been fortunate. We have a lot more commodities, a lot more oil as a larger part of our markets and our economy. So we've been able to I think, avoid recession as yet. But I think as interest rates rise, and if we continue to see increases as we've seen, like today, it could take us into a recession. And I guess I'm just looking at the other parts of the question. Were you surprised to see a full percentage point? Yes, I was. I was expecting a 75 basis point hike. And how will it affect my stock portfolio? As I mentioned, I think stock markets, before I came on the air, were negative today. I think this is from two reasons. Well, mainly one reason. I think it's because the inflation data out of the US was so high. But number two, I think anytime you get interest rate hikes, whether it's in the US or Canada, it's difficult for a portfolio. So I think we have time to take maybe one more question here. How much higher do you think interest rates will go? I see a question on the board here. So in my opinion, I think interest rates can still move higher. I think with today's 1 percentage point increase in Canada, we're looking at a prime rate closer to 5%, in that 4.7% range. But I think we can still go higher. I think the Bank of Canada indicated today that they believe they will have to still raise interest rates. They believe that inflation will remain stubbornly high, in and around 8% for some time yet. And so with that in mind, I think they will continue to raise rates. Now, if anybody is keeping track, I think they've raised rates 4 times this year so far. But make no mistake, if you're someone who's looking to make a budget for yourself, looking at some payments, some debt levels that you have, you definitely want to take future rate hikes into consideration, because I think there will be more. And even though everybody is saying the damage that this could cause the economy. It could take us into recession. Bank of Canada seems to be willing to take that chance, as well as the Federal Reserve. They've indicated that if we do see unemployment start to tick a little bit higher, that they're willing to take that risk. They still believe they can see a soft landing or things turn out okay in the end, but they're willing to see higher unemployment. They're willing to see people, I guess, make those higher interest rate payments if that means bringing down the inflation rate. So I think interest rates will move higher, and I think everybody needs to be prepared for that. I guess we're coming up on 12:30. I've been talking now for about 30 minutes, and so I think we'll cut it off here. I know there are some more questions coming up on the chat lines here, so I'll try and get to those I guess after the show. But I want to thank everyone again for listening in. Today is a very interesting day in the markets, with inflation data being released in the U.S. and Bank of Canada raising interest rates here in our country. I want to thank you once again for sharing your day with me. I know everyone's quite busy, so thank you again. And I look forward to seeing you 2 weeks on our next show on the 27th, same time at 12 p.m. on Wednesday, the 27th. Have yourself a great and prosperous day. Take care.